I dove into Trump's big, beautiful tax bill, so you don't have to. If you're a retiree, you should probably pay attention to some of these, especially the ones at the beginning. I'll be utilizing some of these different data points with my own clients from a tax planning standpoint. Okay, first one is that the standard deduction is changing. This is increasing to 31,500 for joint filers and 15,750 for single. This is permanent and it's going to be adjusted by inflation from here on after. Here is actually the big one though. If you're a senior, this is the additional $6,000, call it senior deduction. This was Trump trying to make good on his promises on the campaign trail to eliminate taxes on Social Security. The data I was able to find right now is showing that about 64% of seniors actually don't pay any tax on their Social Security benefits. And with this additional $6,000 deduction, it's probably going to be about 88% of seniors are not going to be paying any sort of tax on their Social Security. So this only counts if you are 65 and older. Another caveat is that it's only for the 2025 to 2028 tax years. After that, it goes away. There are phase outs for this though. For a married couple, the phase out's $150,000, but it really goes for a long ways. So the phase out lasts until 250,000, which is a lot longer than most of the other phase outs that I typically deal with and my clients deal with from a tax planning standpoint. For single people, you can just divide that by 2. So if you're 65 and older, and let's say you're married, here are the deductions that you qualify for. And again, these are the standard deductions in my personal finance class that I teach. In order to get the concept across, I call it just the free deduction. It's the free deduction that the government gives you. You would have the $31,500 just married filing joint deduction that everyone qualifies for. But then you also get a senior deduction that was already in place of $3,200. And then you get this additional $6,000 deduction, which gets you to $40,700 in, call it free government deductions for the 2025 tax year. That's pretty good. I mean, if you're making $40,000 between your different investments, Social Security, and Social Security is taxed a little bit weird anyway, but you could be making a pretty decent chunk and have no taxes, no federal taxes at all, let alone if you're even making more than that. It's really going to reduce how much you're paying in taxes because you'll probably be in the 10 to 12% tax bracket, which, just to be completely frank, is pretty low from a tax standpoint. All right, another big thing that you should be aware of is the SALT deduction. This stands for state and local tax deduction. Essentially, this is an itemized deduction. So this means that when you add up all these itemized deductions, you compare that to the standard deduction, the free deduction from the government, and you take whichever one is larger. The SALT deduction was $10,000. And now it's increased to $40,000. So what you would do is that you would add up your state taxes, add up property taxes, maybe some other local taxes, and you can take a deduction, an itemized deduction of up to $40,000. And for some people, this might be more than the standard deduction when you include other things like charitable giving. A strategy that you might want to include would be bunching. And what that would mean is maybe in 1 year, you donate a lot to charity. And so you'd have a large charitable deduction, which is an itemized deduction. Add that to the SALT deduction, and now you might have a really sizable itemized deduction in 1 year. And then the years thereafter, you might only be taking the standard deduction because you don't have enough itemized deductions to be larger than the free one that the government gives you. Of note, this only goes through 2029. After that, it drops back down to $10,000. So another reason why you may want to consider bunching your charitable donations in the same year that you're taking maybe some hefty SALT deductions. Okay, here's a fun one. The charitable deduction, they are increasing an above the line, so non-itemized above the line deduction of $2,000 for a couple, $1,000 if you're single, because before, only about 1 in 10 people are actually itemizing. And so if you are giving to charity and you're being generous, but you're not itemizing your deductions, you don't get any sort of financial benefit for giving to charity. I think there's other benefits for giving to charity, such as what you get, for your soul, which can be really good. It can help, the grip that money might have on you, it can pull that away. But you weren't getting any sort of monetary benefit from it. But now there is a $2,000 non-itemized charitable deduction benefit that you'll get married filing joint. Another boost is an increase to the estate tax exemption. So right now, the estate tax exemption, meaning that you can have an estate of such a size and not pay federal estate taxes, is $15 million per person. So if it's a couple, you actually can get double that and it'd be $30 million a person. And this doesn't apply to a ton of people, but what I often see in my area in the Midwest is this is huge for farming families because they may be asset rich with a lot of land, but they're actually cash poor. And if someone dies, it might be tough to come up with the money to pay those estate taxes because you can't just sell off a few pieces of land here and there. You typically have to sell off a large chunk for someone else to even be willing to buy it, right? Who's going to buy an acre of not great land in the middle of your property? You probably don't even want to sell that. The estate tax exemption will be tied to inflation thereafter. If you were hoping to get an electric vehicle, that credit for getting an electric vehicle is going to run out on September 30th. It gets a little bit complicated on which vehicles qualify, new or used, so you can look into that, but those electric vehicle credits will probably be gone by September 30th. A completely brand new deduction is an auto loan interest deduction. So you can now take an above the line $10,000 auto loan interest deduction if you're buying a new car. Now, there are some caveats. The new car has to have final assembly be in the United States. I don't even know if we have a full list of who qualifies for that right now. The vehicle can't be used for commercial purposes. It has to be for personal. There's a weight limit. I want to recall it was 14,000 pounds. Your adjusted gross income has to be 100,000 or less if you're single, 200,000 for married. And some analysis people have done is that you really couldn't take full advantage of this deduction unless you have an auto loan of like 110 to $130,000. So unless you're buying, high end luxury vehicles, you're probably not going to get much benefit from this. Still some if you buy a new car and you finance it, but it won't be the full 10,000. So this may apply to you as a retiree. No taxes on tips and overtime. This may apply to you as a retiree depending on your line of work. Essentially, right now, and just so you're aware of how this is working, you can deduct $25,000 of your tips or $12,500 of your overtime pay. It's only for 2025 to 2028 tax years, and only certain professions actually qualify for this type of deduction. So you can't be someone who didn't have tips as a part of their work and now you're saying, hey, pay me $1 but then give me a giant tip. We don't know exactly which professions qualify for this, but we'll know in 90 days after the bill is passing. If you're a retiree, you probably don't have a young child, but you can tell your kids that the child tax credit was increased from $2,000 to $2,200, and it's going to be permanent. One of the things about the child tax credit is that in the last, 10 years, it's just whipsawed because we had the Tax Cuts and Jobs Act, then we had COVID, then we had the Secure Act, and it just goes back and forth. But now it looks like it'll be fairly permanent at 2,200. If you are someone who likes voucher schools or private education, so there's this new tax credit up to $1,700 for donating to organizations that do scholarships for school vouchers. Now, there's still, I think, a lot of details that need to be ironed out. Different states have to actually opt into this. So I think there's probably going to be a lot of debate in your local state about this school voucher tax credit. I don't know all the details yet, but certain organizations, if you give money to them that they go make those scholarships, you'll probably get a deduction, a tax credit, actually, not a deduction, a full tax credit of up to $1,700.